All right, I'm going to explain put options as quickly and coherently as possible. So a put option, let's just look at a stock in Robinhood. Let's go Ford. So there's two types of options. There are put options and call options. I'm just explaining put options right now. So to find the options, go to trade Ford options right here. You'll see a page just like this. Now let's go back for a minute. Ford is trading at $9.36. So I actually have 150 shares of Ford, bought it at like 940 something. So the most basic way to use a put option is for insurance. Put option is an insurance contract. That's the most basic way I can put it. So if I say I have my 100, say I just had 100 shares of Ford stock and I bought it at 940 something. Well, what happens if the CEO quits, dies, something horrible happens to the company? They come out with a scandal and the stock drops $5. Well, I'm out $5 times 100 shares, $500. That's not ideal. A put option protects you against that. I'll show you how. So to protect against that scenario, to buy your insurance contract, per se, you could buy a put option. Now, if let's say I bought the stock at 950, I could buy a 950 put option for 18 cents a share. Now, call and put option contracts, they're contracts, and the contract always represents 100 shares. So you have to multiply whatever the price is by 100. That's going to be the actual price you pay. So if I just want to buy a put option, buy, put, choose the 951. It's called the strike price, so buy the 950 strike. Hit this plus symbol, 18 cents. Hit continue. See, a contract shows 100 shares each, so make that 1. The price is $18. So in Robinhood, I love Robinhood. It's great for starting out because it's really dummy proof. It tells you exactly what you're doing. So before I even submit, it says you're paying $18 for the right to sell 100 shares of Ford for $9.50 per share by January 3rd, which is this Friday. You can change the option too, but essentially, if the stock crashes and I have this contract, I buy this, I can sell my 100 shares for $9.50, guaranteed. Even if the company goes bankrupt tomorrow, and stock's worth $1 or $0, and I want to sell my shares for $9.50 a share, well, this is my insurance contract to do that. That's going to cost me $18. So in the scenario where the stock dropped $5, instead of losing $500 when you're holding 100 shares of that stock, you'd buy this contract for $18, put this contract into effect when that scenario happens, which is called exercising the contract, and you get your full $9.50 a share for all 100 shares. If you have 1,000 shares and you wanted to buy the same type of contract, you just put 10. If you had 200 shares, 2 contracts, contract is 100 shares. That's why. So that is the way to use a put option for insurance. Now, who are you paying this to? You're actually not paying to the brokerage or anything like that. You're actually you're buying that contract from someone else in the marketplace. So, which brings me to selling put options. I can be the person that sells this option to other people, and for doing so, that 18 cents a share or $18 I would actually receive. Why would I do that? Well, no one's going to exercise their contract against you if the share price is above $9.50. If I was selling this contract and the stock goes up to 960 or 980 by the time this expiration date hits, no one's gonna exercise their right to sell the 100 shares for 950 when the stock is trading for 960, 970 or whatever. If it's higher than the strike price and you're selling a put, if it ends higher, you're going to receive that credit as a seller of the put. So stock is currently trading at $9.36 right now. That's why the more expensive the strike price, the more expensive the option, because Ford isn't even trading at $12 right now. So if I want the option to sell my stock for $12 a share, well, it's going to cost me a lot. It's going to cost me $2.63 times 100. On the flip of that, if I want to have a really good chance of getting the credit when I sell the put option, I could scroll down and choose one of these that's significantly under what the stock is currently trading at. So if I wanted to sell a put for $7.50, I only get 1 cent a share, so $1. Not too fun. So you don't really have much you don't have much playing room selling puts. If they're like really, if they're really safe, you're not going to make a lot of money. You can only really make money if it's a higher chance scenario. So this stock doesn't have the best options. It's just a stock that doesn't move a lot, pretty much stays stagnant most of the time. So we went over buying put options, selling put options. Now I'm going to show you something more fun, which is called a put debit spread, where you actually do both. You sell a put option and you buy a put option. So let's look at Apple. Apple's currently trading at $290 exactly. So if we go to trade Apple options, now if I wanted to sell an Apple put, that's not something I'm going to be able to do because I'm not rich. So I'll show you what I mean. Say I wanted to sell an Apple option at $290. Apple, if we look at Apple on this, what is this? The 3-year graph. Let's look at a 1 year and by the week. This is when the trade deal, or the sanctions on China went down. This is the only time in the last year where they had any significant downward trend. So pretty much every single week, Apple has stayed at their stock price or gone higher than their stock price compared to the previous week. So that makes me feel like in 2 weeks, Apple's most likely going to be trading at $290 or higher than $290. So I want to pick an option that is next Friday, not this Friday. So this Friday is the 3rd, next Friday. So 2 weeks. I want to sell a put for $5.48 a share, which is $548 credit I would get. That's way more fun. This is how people with money make, it's like the rich getting richer scenario. I mean, it's a pretty easy bet, saying I will sell you 100 shares of Apple for $2.90 if the stock price is $2.90 or lower. Given that Apple has gone up every week for the most part for the entire year, it's like a very sure bet, at least in my mindset. Statistically, for the last year, that's a really safe bet to make if you had the capital to cover it. The problem is I don't have the capital to cover it, and most people don't, because if I wanted to sell put to get that $548 credit right away, I have to, in the case that Apple is at 290 or below 290, below 290, I have to then I have to own 100 shares of Apple to deliver to the person, to fulfill my end of the contract. Even though I don't think that's going to happen, things happen. So it could definitely happen. I don't want it to. In this scenario, I don't have 100 shares of Apple. So Robinhood is telling me, in case this bet goes wrong, you don't have enough money to cover it. I would need $26,000, almost $27,000 in my account to cover it, because Apple, I already have a few thousand in my account, but Apple's trading at 290 and I need 100 of them. I need 29,000. I have a couple thousand buying power. I'd need to deposit $27,000 more to cover that bet. Yeah, not doable. So what we do, it's called the Put Credit Spread. So I can actually do it, sell it, and then I buy a put, that insurance contract, for the strike price right below it. So when you buy a put, it's basically, now instead of having the risk of Apple going way, way down and me having to pay for it, I can sell the put at 290 and then buy a put right below it at 287. So instead of getting this 548 per share, $548 total, I'm getting what's in between these two prices, meaning if we just go 5.48 minus 435, that's $1.13. So I'm actually getting $1.13 total credit in a contract, 100 shares, so 113 bucks. Now, when you sell and buy a put, this is the one I'm selling, this is the one I'm buying, it automatically turns it into a put credit spread. I hit continue. Let's hit review order. Now I only need $250 instead of tens of thousands of dollars. I only need $250 of collateral to place this bet, and the bet still pays me $113 as long as in 2 weeks, the Friday after Friday, 2 weeks from now, if Apple's above 290, I get that $113. Why is it asking for $250? It's actually less collateral, and I'll show you how to calculate it. There's a couple rare scenarios that could come up where you would need more collateral than what I'm going to show you need, which is why Robinhood doesn't do the best job of displaying this. But essentially, your only risk, remember, you get this $113 credit, so that's factored into the risk. The risk is the length of the spread difference between these two numbers, the 287.50 and the 285, or sorry, 290 versus 287.50, which is 288.50, 289.50 plus 50, so $2.50. The spread difference, because if you go 287.50 plus $2.50, that equals 290. So $2.50 is the spread. Now we get $1.13 a credit, worth of credit for every share. So we actually deduct that minus 113. So our risk is $1.37 in a contract. That's times 100. So even though Robinhood's showing this 250, the maximum risk we have is actually $137. So I'm risking $137 to win $113. It's a pretty good bet to me, and I'm just going to exit some of the stuff out to show you that statistically, this chance of profit, selling this put in the first place at 290, based on what's been happening and my expiration date, based on all the other expiration dates for the year, statistically speaking, I have a 65% chance of this bet working. Now, if I have a 60, let's just call it a 60% chance. So when I lose, so say I lose 4 out of 10 times, right? Or 60% chance out of 100%, that's being right 6 times, being wrong 4 times. So if I'm winning $113 every time I'm right and losing $137 every time I'm wrong, it looks like 113 times 6, that's the 6 out of 10 times going to be right, 678, and then 137 times 4 is 548. So 678 minus 548. If we did this did this option spread 10 times, I should net a profit of $130. If I do it 100 times, that should be $1,300. So, you know, previous results never, I mean, they don't guarantee the results you're going to get in the future. Are they correlated? I think they are. I mean, it's literally just looking back in the past. So it's sure a much better bet than lots of other types of bets in gambling or anything, even the stock market, that you could take. It at least has some sort of data behind it. So if we wanted to get ballsy, we could sell this put at 290, buy the put right below it, 287.50, hit continue, and then we could bring this up to 10 contracts. So now things are getting serious because we're risking this number is skewed a little bit, so it's that 137 times 10. This is what we're risking, $1,370, risking that to potentially make $1,130 with statistically a 65% chance of being right. So I'm going to submit this. and it's after hours, so this is going to get filled in the morning. Now, here's the big kicker. Get Apple again. So if Apple starts going up tomorrow morning, which is Monday, those options are automatically going to change in price in real time, very quickly. And if Apple goes up to $291, that option is going to cost a lot more. That that put option that I'm selling is going to pay a lot less credit. So currently it's at 290 with no information. The market's closed. That's where it's stuck right now. It's paying me $5.48 a share, 548 total, just for selling this naked put option. But the second Apple starts going up, which I assume it will, if it starts going up, the credit I get if I were to buy this then, or sell this put contract then, it may only give me $4 a share or $3.50 a share. And then if it starts going down, the opposite happens. So I'm putting it in right now because I suspect it's going to keep going up, and I get more premium for betting right now. So that's my bet, and hopefully now you can make ones like that too.